There's one mistake that I see over and over again that's costing business owners hundreds of thousands of dollars in taxes. Yeah, just one single mistake. It's how they structure their business ownership. It's what type of entity they use. See, they hear a lot of things about these different entity types like C corporations and S corporations and partnerships and limited partnerships and LLCs. And they go, well, wait a minute, okay? What am I supposed to do? And what happens is that they get with the wrong tax advisor or they make a bad decision because what they've heard is, well, S corporations are good. So let's take that mistake. S corporations are good. And I'll give you a specific example. I just ran into this yesterday with a client. So their tax advisor had told them, well, S corporations are good. I said, okay. So their business was investing in long-term real estate. So they put their long-term real estate in an S corporation. Well, S corporations are good for certain things. They are really bad for investment real estate, really bad, because what's going to happen? Okay, so when you invest in real estate, the best thing in the world is to be able to refinance and use the refinance money for new investments. However, a lot of times in order to have that refinancing, the bank wants you to put that money, put the title of the asset, put the title of that property back into your personal name. Do you know if you're in an S corporation, you put that title back in your personal name, that's a taxable event. That's as if your S corporation sold it to you at fair market value. Think about the thousands and hundreds of thousands of dollars that would cost you. But that's not all. I find this happening all over the place. I have another client, a new client that came to me and said, hey, okay, here's what we're doing. We're taking most of our money and we're reinvesting it in the company. And I said, wow, and you're an S corporation? I said, yeah. I said, man, I really think you should be a C corporation. I said, well, how do we do that? Well, one answer would be to convert your S corporation to a C corporation. You can do that. I said, but I don't think that's your best answer. Now, just doing that would save this client millions of dollars, and they're a very successful business because corporate tax rates, C corporation tax rates, are far lower than personal tax rates. Well, what does that mean? Well, that means that if you're going to leave the money in the business, leave it in, why would you want to be taxed at a higher rate when you could be taxed at the lower corporate rate? So we want to do one more thing. I said, but wait a minute. Do you think you'll ever sell the business? Well, yeah, eventually. Everybody's going to sell their business, right? So what if we could sell the business and not pay tax on the capital gain on that business? Well, would you like to be able to do both? Both get the low corporate tax rate and not pay any capital gains tax when you sell the business? Well, yeah, that's seems too good to be true. Guess what? It's not too good to be true. It's a very simple mechanism to set it up so that you get both your cake and you get to eat it. So you get that 21% rate and you pay no tax on your capital gains. But you can't do it simply by converting your S corporation to a C corporation. You actually have to form a new corporation. Now, does this sound a little complicated? It is a little complicated. It's why you hire good tax advisors. It's why you sit down with a tax advisor every time that you're looking at, okay, what kind of entity should I use? Because no entity is good or bad on its own. Entities are agnostic. But entities are good for certain entities are good for some things, and certain other entities are good for others. I'm going to give you some, just lay it out there, okay? If you're talking about investments and you want to protect your investments and you want to put them into entities, I think that's a good idea. Should not be a corporation, neither a C corporation or an S corporation. It can be an LLC tax as a partnership. It can be a limited partnership. It can be something other than a corporation. Let's say instead though that you have a business. Well, now I don't want to be in a partnership because if I'm in a partnership, I'm going to pay Social Security taxes on 100% of my income. Why would I want to do that? That's going to cost me thousands and thousands of dollars. One of our clients recently, we just saved them $21,000 simply by reducing the amount of salary they paid out of their company. I mean, this stuff is to me, it's so obvious, but it's how have I set up my business? What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single year. That's right, 100% write-off. Now, if you have $100,000 in W-2 or business income, you could purchase $100,000 of miners and potentially offset it entirely. And you have to dot your I's and cross your T's. So make sure when you are doing this that you plan with your CPA tax strategist. Blockware's mining as a service enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day while also saving big come tax season. We always want to make money first, and then we want to make sure we're saving taxes on that money that we make. None of this is tax advice. So go speak to the team at Blockware to learn more by going to mining.blockwaresolutions.com/Tom and meet with your tax advisor. If I'm going to take all my money out of the company, boy, an S corporation makes a whole lot of sense. If I'm going to leave my money in the company, a C corporation makes a whole lot of sense. Well, what about in between? Well, that's where you always have to run the numbers. Now, anytime you are doing tax planning, I'm going to tell you, you need to run the numbers. Sit down. This is why your tax advisor should be a CPA. I am very strong on this. Do not have your tax advisor be an enrolled agent, because CPAs are really good with numbers. And when it comes down to it, taxes are about running the numbers. I'll give you an example. So you want to be the C corporation or the S corporation. I'm going to run the numbers. Well, what's going to work out best? Well, it depends on how much money I'm going to take out. How much salary am I going to pay? When am I going to sell the business? When am I going to sell the business? What's going to happen with the business? See, these are all questions that I'm going to ask you if you were my client to see what type of entity is right for you. But if I don't ask those questions, then chances are I'm not going to get you the best result. Better results come from better questions. So make sure that your tax advisor is asking those better questions, particularly when it comes to setting up your business or your investments into the right entities. Don't believe that just because you heard it on social media, you saw a video, even my video, don't believe it. Take it to your tax advisor and have them explain it to you. By the way, just a little note about tax advisors. If your tax advisor cannot explain it to you, they don't understand it. Now, there could be two reasons they don't understand it. One is that they just don't understand it, okay? The simple reason. But the other is it could just be false, right? It could not be, it could be that it doesn't work. I had that situation a couple of years ago where one of my clients, always looking for new ideas, brought me a tax idea from a tax attorney. And I'm like 10 minutes into this and I'm going, this doesn't make sense because that's not what the law means. And he goes, what do you mean? He says, it's right here. I said, no, you're reading it wrong. This is not what the law says. You are misunderstanding the law. And I got pretty upset. The client actually had to cut us off. He goes, I knew we were not going to get anywhere because you knew what you were talking about. And he clearly did not. Yes, continue to learn. Please get the education. But sit down with your tax advisor. Challenge your entities. I have a client right now where we're actually, we've built these entities up over the years, and sometimes you end up with a lot of entities. And he said, are there any entities we can get rid of? And I said, yeah, there probably are. Let's get rid of some entities. I have one client, we're going to drop 25 entities. We're going to get rid of them. The client situation has changed. We don't need those. So why do you have something you don't need? So sometimes it's not just, well, hey, I need a more sophisticated entity structure. Sometimes you need a less sophisticated entity structure, because what you don't want is you don't want to have huge accounting fees, huge tax preparation fees, if you're not getting the tax benefit from setting up those entities. So sit down with your tax advisor, go through your entities, make sure they draw it for you. Make sure you get a picture. We call it an entity map. We actually have software that does this for our advisors and our clients. Make sure you look at it and go, I get it. Oh, that's right. Because if you understand it and you understand why, then you're going to be successful with your entity structure. Most entrepreneurs, investors, they'll just set up an LLC and they say, hey, in fact, I'll ask them, so tell me how your business is taxed. So I'm an LLC. What they don't realize is, to begin with, is LLC is a legal designation, not a tax designation. So if you tell me you're taxed as an LLC, I don't even know how you're taxed because there is no taxed as an LLC. Let's break it down just a little bit. You're either taxed as a corporation, and as a corporation, either an S corporation or C corporation, you're taxed as a partnership, either a general partnership or a limited partnership, or you're taxed as a sole proprietorship. Those are your choices. Now, here's what I love about LLCs. LLCs are really flexible. You can actually choose any of those. So when we talk about tax structure, we're not talking about LLC versus partnership, because an LLC can be a partnership. We're going to talk about corporations versus partnerships versus sole proprietorships. So the reason you use an LLC is solely for asset protection. I'm not an asset protection attorney. I'm not an attorney at all. So I'm going to refer you to asset protection attorneys to talk about the asset protection benefits of an LLC. What I like about them is I like being able to choose what's good for asset protection. In a lot of cases, that's going to be an LLC, and choose my entity. And what's even more is sometimes I want to be a partnership starting out and then become a corporation. And the only way to do that is with an LLC. So here's the thing. People think, okay, I set up an LLC, I'm done. You're just starting. You are far from being done. Because again, if you set up an LLC, by the way, and you set it up just by yourself, you're a sole proprietorship, which is the worst thing to do from both a tax and an asset protection standpoint. What you want to do is, first of all, you don't ever want to be a sole proprietorship. Please don't be a sole proprietorship. That means you're going to be on a Schedule C if you're a business, or a Schedule E on your personal tax return if you're doing rental properties, even short-term or long-term. Schedule E. Why is that a problem? Because you have a much higher chance of being audited by the IRS, because the IRS doesn't trust you. Why don't they trust you? Because you only have one financial statement. You have a profit and loss statement, or what's also called an income statement. You don't have a balance sheet. And so they don't trust you. It's like one-sided entry. It's like, it's kind of like saying, well, I caught a fish. If you had two sides, you go, I caught a fish this big, this big, this big. I caught a fish this big, right? That's really what you're saying. If you're a sole proprietor, either as an investor on a Schedule E or a business owner Schedule C. Plus, you create self-employment tax issues with your business. Just don't be a sole proprietorship. I used to think it was okay at certain points. I don't think so anymore. So then the question is, okay, so when do I use a C Corp? When do I use an S Corp? And when do I use a partnership? Because the entity structure from a tax standpoint is going to determine how much tax you pay, whether and how you can shift income to other brackets, how you pay yourself, and how much of your profit you get to keep and reinvest. Entity structure is not just a legal thing. So here's the challenge with a lot of attorneys. They'll give you the legal structure, but they're asset protection attorneys. I have friends, good friends, who are asset protection attorneys. The really good asset protection attorneys, they let the tax people do their job. That's me. Now, I understand asset protection because I've been studying this for so long, but I always work with an attorney on this. But here's the thing. The tax law is much more complicated than asset protection law. The tax law is thousands of pages. The asset protection law is like 50 pages. So it's just, we always start with the tax side of things. I'll do my best from a legal standpoint, and then we'll talk to the attorney and have them make sure it works from an asset protection. But most people start with the asset protection and forget that they really ought to be starting with the tax. That's the most important part, because it makes such a big difference on how much tax you pay. Simply, for example, going from a sole proprietorship to a single member S corporation can save you as much as $15,000 or $20,000 in taxes a year. $15,000 to $20,000 simply by being an S corporation instead of being a partnership. I mean, it is enormous amounts of money. So let's go back to the LLC for a second. Everybody's favorite default is I'm going to be an LLC. That's fine. you're an LLC. It's easy, it's cheap, it's common, it's great. Gives you asset protection. But again, LLC is not a tax strategy. Like I said, by default, a single member LLC is a sole proprietor. A multi-member is a partnership. That means as either a sole proprietorship or a partnership, you're paying 100% of the income is subject to self-employment tax. How much is self-employment tax? Anywhere from 15.3% to 16.2% on top of your income tax. That's right. An extra 15 or 16% on top of your income tax. So why not set up as an S corporation, for example, and eliminate a lot of that self-employment tax? The other thing is, with a sole proprietorship, it's much more difficult to shift income to a lower bracket, to split the income. Now you can, if you're a partnership, you can split it that way. And here's what I'm going to tell you. All of these entities that I'm talking about are good in the right situation and bad in the wrong situation. So they're not good or bad entities. They're good or bad depending on the situation you have. So let's start with S corporation. So if you think about Robert Kiyosaki, my friend Robert Kiyosaki's cash flow quadrant, he goes, that's the S quadrant, right? The E quadrant is employees, S quadrant is self-employed or small business. That's where S corporations make the most sense. Why is that? Well, first of all, we want to get rid of that sole proprietorship or general or partnership so that you're not paying self-employment tax on all your income. But second of all, it's because you're probably taking all the money out. If you're a small business owner, basically, for the most part, you own your job, right? Let's face it. Small business owners own their job. Well, that means you need the money. Well, you don't want to pay tax twice. If you were a C corporation, you'd pay it once at the corporate level and once again when you take a distribution. In an S corporation, you only pay tax once, and that's at the individual level. So the corporation itself doesn't pay tax. Well, that can be really good because you should be, by the way, you've heard top tax bracket is 37%, but not for an S corporation. An S corporation top tax bracket is 29.6% because we get this qualified business income deduction. But again, you've got to plan for that, because if you don't take the right salary and you don't plan right for your S corporation, you could lose some of that qualified business income deduction and end up in a higher tax bracket. So here's what you need to do. I always say it's okay to act small, but you've got to or think small, and you might be a small business, but you've got to act like the big guys. Okay, so think of that yourself as a real business. So what does that mean? Well, it means not only do I have an income statement, I have a balance sheet. Preferably, you also have a statement of cash flow. But let's just talk about the income statement balance sheet. An S corporation forces you to have an income statement and balance sheet. That's why S corporations are audited about 80% less than Schedule C, sole proprietorship. Okay, so that's the first thing, is that you've got to act like a real business. So in a real business, what would happen? Well, you're an employee of the company. And how do you get paid as an employee of a company? You take a salary. Well, how much salary do I take? Well, of course, we want to take the least amount possible because salary is subject to Social Security tax, which is the equivalent of self-employment tax. So we want to minimize that salary. However, we do have to take a reasonable salary. So here's the way I look at it. Look at what would you pay somebody else to do your job in the company? Not as the investor, not as the owner, but your job in the company. What would you pay somebody else to do that job? That would be a reasonable salary. Now you can be on the low end of that range. That's fine, but that would be a reasonable salary. I like to say that, if you really don't know what a reasonable salary is, and you can look it up online, but if you pay 40 to 50% of the money you take out is taken out of salary, you're probably okay. I've not seen the IRS challenge that. There's no guidelines on that. I'm not telling you what the law is. I'm telling you, I've just not seen the IRS challenge that. So what do you do with the rest of the money? So you take let's say you take 50% out. Let's say you make $100,000. 50% comes out of this, $50,000 comes out of salary, and $50,000 comes out of a distribution as a distribution. The distribution is not subject to Social Security taxes. That by itself is going to save you $10,000 to $20,000 a year. Okay, you can see. I mean, if I can cut my $15,000 down to $7,500, right? That would be $100,000. That's $7,500 that I'm putting in my pocket, and I never have to pay it back. What if I'm at $200,000? So it gets bigger. The bigger your income is, the more savings there are with the S Corporation. But again, S Corporation is a great place where you build a business, but you're taking most of the money out every single year. One caution, please, please, please do not put real estate into an S Corporation, investment real estate. Why did I say you want to be an S Corporation instead of a partnership or sole proprietorship? Well, the reason is self-employment tax. But there is no self-employment tax on real estate rental. So why would you give up the flexibility of a partnership? Now, I am a partnership expert. That is my technical expertise, is partnerships. That's what I did in the National Tax Office of Ernst & Young. I was on the partnership team. There were 5 of us nationally to handle the partnership team. That was my team. So I love partnerships. So I try to avoid corporations because they've got more rules to them than partnerships. However, an S Corporation makes so much sense if it's a business subject to self-employment tax. But real estate makes no sense. On top of that, for whatever reason, you have to pull that real estate back out of your business. Guess what happens? You have to pay tax. The S Corporation pays tax as if it sold the property to you at fair market value. So let's say all you're doing is refinancing it. You're going to put it into your personal name, refinance it, and then deed it back to the company, the LLC, right? But if the LLC is an S Corporation, that getting it out of the company, that's a distribution, and it actually creates a tax liability. So no reason to put investment real estate into an S Corporation. So please don't do that. If you hear people doing that, or if you've done it, you need to sit down with a good tax advisor and figure out a way to take care of that, because it can be an issue. Now, let's talk about C Corporations, because I hear a lot of small business owners saying, I'm just going to be an S Corporation. I'm done. I'm going, yeah, but really? Are you really done? Because you're giving up a lot of potential tax savings. Here's why. See, let's say you're not taking all the money out. Let's say you're reinvesting this, because here's what we know. As a small business owner, so as an employee, remember, we get paid once. We render our services, we get our paycheck, and that's the only pay we ever get. As a business owner, we get paid twice. This is the reason to own a business. To me, the primary reason. You get paid twice, because you get paid once in the income that comes in, but what does that income create? It actually creates value of the business. So when you can then sell the business down the road and you get that income that's built up, let's say you get a multiple of that income and you get to sell it, you get capital gains on it. But here's the point. You're getting the income once, you're selling it and getting the income again. So you get paid twice with the business. Now, with a C Corporation, if you're going to leave the money in and you're going to keep building it up, guess what? C Corporation maximum tax rate, 21% versus that 29.6%, almost 30% if you're an S Corporation. So wouldn't you rather be a C Corporation? Yes, if I'm not taking all the money out, right? If I'm just taking a salary out, that's fine. We're going to take salary out of an S Corporation anyway. Now I can take that salary out, but I'm going to leave the money in the C Corporation, and it's going to compound because I only have a 21% tax rate instead of a 30% tax rate. So it's going to compound that much faster. On top of that, if I leave it in for 5 years before I sell the business, and I sell the actual business, and of course, I dot my I's, cross my T's, do everything else I need to do with a really good tax advisor. When I sell that business, I could pay zero capital gains tax. That's called Section 1202. So if you haven't heard of Section 1202, you need to absolutely talk to your tax advisor about Section 1202. Why haven't you talked to me about Section 1202? Should I be a C Corporation instead of an S Corporation? And not only do I get a lower tax rate now, but I pay no tax when I sell the business. It almost sounds too good to be true, and yet it's absolutely true. And I've actually defended 1202 on an audit. It's not a big deal because the law is pretty clear on what it means. So here's the reason the wealthy use C Corps. They're retaining the profits at a lower tax rate. Fringe benefits like their health insurance and healthcare, instead of having this limitation on how much you can deduct like you do through an S corporation, you can have unlimited deductions. So you can have $50,000 in medical deduction and take $50,000 in a C corporation. That's the one big difference on what's deductible to a C corporation versus an S corporation. You might reinvest the profits, research and development, marketing, customer base, intangibles, and you're creating this long-term holding company. C corporations can be very, very powerful for legacy planning as well, because remember, if the C Corp, another way for the C corporation not to be taxed, let's say you die owning the C corporation. What happens to that capital gains when you die? It disappears. You have no capital gains anymore. So your heirs can sell your business to, let's say, one of your partners, whoever, one of your business associates. They can sell the business and not pay any capital gains rate. So C Corps can be very important in your planning. Okay, now we're going to take the same business with $250,000 in net income and run it through three different structures. The first one, we're going to run it through a sole proprietorship or partnership. So all of them are going to be LLCs. It's just going to be, how are we taxed? We're going to tax as a sole proprietorship or partnership, as an S corporation or C corporation. The LLC is taxed as a partnership or sole proprietorship. You got the net income of $250,000. Your self-employment tax is going to be roughly $30,000, a little more or less. Income tax going to be about $60,000. So your total tax liability is about $90,000. Well, what does that mean you keep? That means you keep $160,000. But let's say instead you're an S corporation. And let's say you say, well, I think $100,000 salary is appropriate. Now my payroll tax is only $15,300. My distribution of $150,000 pays no self-employment tax. My income tax is also could be lower. So let's say my income tax is about $55,000. So my total tax is right around $70,000. So instead of a tax of $90,000, I have a tax of $70,000. Okay, which means that what I'm keeping is, out of the $250,000, I'm keeping $180,000. Okay, now $180,000 is a lot better, right, than the alternative of $160,000. Now let's say that I leave it all in the company. I'm a C corporation. You decide, hey, I'm going to reinvest a lot of my money in the business. I'm only going to take out my regular salary, but I'm going to reinvest the rest in my business. I'm going to be a C corporation. What does that do? Well, it means that we still have the payroll tax, $15,000 approximately, on the $100,000 of salary. We also are going to have personal income tax on that $100,000. Let's say it's about $15,000, could be more or less. And then another $30,000 approximately, $30,500 on the $150,000 that we've left in, right? So we'll say that's roughly 30, which means we have a total of about $60,000. So we've gone from $70,000 to $60,000 because we didn't take the $150,000 out of that. Okay, so what that means is that now we have $190,000 left in the company. So we're actually getting to use $190,000, right? Both inside and out, we get $190,000. So what you see is there's an incremental increase going from the partnership, sole proprietorship, where you only keep $160,000, right, to the S Corp, where you keep $180,000, to the C Corp, where in this case you keep $190,000. On top of that, in the C Corp, if you set this up under 1202, when you sell the business, you pay zero tax. So same $250,000. But with the right structure, you're saving $30,000 or more in tax every single year. You're not ignoring and putting blinders on and saying, hey, I just don't want to be audited. You are more likely to be audited, by the way, as a sole proprietor or partnership than you are as an S Corp or a C Corp. So you're not helping yourself. You're paying higher taxes and have a higher chance of being audited. Now, one thing we can do, which I love doing, is I like layering entities. In other words, I like using multiple entities for the same taxpayer. So let's say you run a 7-figure consulting business. You use an S corporation, you pay yourself salary, save on self-employment tax. You have a C corporation, hold your brand, the IP, license the IP, and you maintain the retained earnings for marketing, research, and development. And then you might have an LLC as a management company. I'd have that still be an S corporation. That's fine, which leases staff and equipment. Great. Now what we've done is we've split up your income among multiple entities. We've leveraged the fringe benefits. We've got good asset protection and all paying far less tax. Now I'm going to give you one more. I'm going to tell you one of my favorite structures. And I'm going to tell you, and this is free. I normally charge a lot of money to tell people the structure, but it is one of my favorites. Let's say you have a partner in your business. Well, if you're an S corporation, and let's say you're 50-50, that's fine. And you could be an S corporation. What's the problem with that? Well, there's no flexibility in S corporations. So that means that if the business earns $500,000, you each get $250,000. And if let's say you each had a car that you used in the business, you'd each get 50% of the deduction for the other person's car. But let's say you buy a $100,000 SUV and they buy a $30,000 used Toyota. Well, they're sharing the cost of your SUV and you're sharing your deduction from your SUV. What do you do instead? This is one of my favorite structures. Here's what I do. We actually set the business up as an LLC taxed as a partnership. You go, wait a minute. You just told me not to do that. Okay, but we're not done yet because you own your 50% through your own S corporation and your partner owns their 50% through their S corporation. What does that do for you? Well, your partner's vehicle, that $30,000 vehicle is paid out of their S corporation and your $100,000 SUV is paid out of your S corporation, which means you get the deduction and you pay for the cost of the SUV. They get the deduction, they pay for the cost of their $30,000 Toyota. See how that's much more fair. You've got a lot more flexibility when you combine the entities than when you just use a single entity. So where do you start? First thing is look at your current structure. Have your CPA draw an entity map. So it literally is a diagram. Okay. Some people call it a structure diagram. I call it an entity map that actually maps out what all of your entities are, who owns it, what percentage and everything. It's a visual. We actually, at my company, PLA Software, we actually created a software just to make entity maps. That's how important these things are. So why is that important? Because then I can send that entity map to an attorney and they know exactly what they're looking at. And they can say, hey, wait a minute, could we do this or this? Yeah, okay. But they have a picture. Picture is worth 1,000 words. Okay, so first you look at your current entity structure. Does it give you what you need? Then sit down with a good tax advisor that actually specializes in tax strategy, right? Tax returns happen at the end of the year. Tax strategy happens all throughout the year. And come up with a tax strategy. And this tax strategy almost always needs to begin with your entity map because about 50% of your tax savings from your tax strategy is come from how you set up your entities. It's that big of a deal. Work with a team who understands entity design, not just accounting and tax return compliance. You're not going to be able to build wealth by default. Your single biggest obstruction to reaching your wealth dream is taxes. It is your single biggest obstruction. It is the single biggest weight holding you back. What we do is we build wealth by design. We actually design a wealth and tax strategy. See, the government gives incentives to those who do what the government wants you to do. They invest in, create jobs. They create housing, create energy. They invest in agriculture, and they invest in the economy in general. All of all those incentives start with doing the right entity structure. See, I'm not going to put investment real estate in the same entity as I put my business. And it may depend on what state I'm in. So there's a lot to this. Now, I don't sell LLCs, C Corps, S Corps. That's not my business. I'm here to sell you on thinking differently, understanding that if you want to have what the wealthy have, you have to behave like the wealthy. If you want to have what the wealthy have, you have to behave like the wealthy. What do? They have really good entity structures. They're using all the different entities so that you're not just making money, but you're keeping your money. I've helped thousands of entrepreneurs make this change. And when they do, they ask the same question: why didn't somebody tell me this sooner? If you're serious about keeping more of what you earn while protecting the business you built, it starts with how your business is structured. Let's break it down. So why is the wrong entity structure one of the most common mistakes entrepreneurs make? And I will give you two words, and they're both four-letter words, but they're not cuss words, don't worry. Easy and lazy. These are the two four-letter words that are really stealing your wealth as an entrepreneur. Why? What's going on? Well, you may have had a tax preparer or a so-called tax advisor. You may have had somebody tell you, well, hey, you're too small. You should just be a Schedule C. So Schedule C is like a solo entrepreneur, right? Just a single member limited liability company, or not even that. You just open a bank account, right? And you start a business and you report it on a Schedule C on your Form 1040, your personal tax return. What's going on here? Well, what's going on is, first of all, the IRS doesn't trust you. Why don't they trust you? Well, because the IRS likes double entry accounting. Double entry accounting is pretty simple. It's debits on the left and credits on the right. Well, why do they like double entry accounting? Well, double entry accounting means that you're more likely to be accurate. In fact, it's kind of hard to be too far wrong if you use double entry accounting. That's the magic of double entry accounting. Schedule C is single entry accounting. You get one side without the other. So of course the IRS doesn't trust you. Second of all, you're paying Social Security taxes on 100% of your income. Now, if you have employees doing work for you, why are you paying Social Security taxes on the income you earn from their work? They're paying Social Security taxes on that. Why are you also paying Social Security taxes? So you're doubling up on Social Security taxes. You shouldn't be paying Social Security taxes on the income that is produced from your employees or from your product, only on the income that you work for. So that means that's why we have to set up a different entity structure. We can't be a Schedule C. We can't be a sole proprietor. We need to actually look at a different type of entity, like an S corporation or C corporation or limited partnership. Now, how much money can the right structure save a 6 or 7 figure business every year? I estimate that when we do take on a new client, and we only take them on if we can save them taxes, but when we take on a new client at TFW Advisors, what happens is that the very first thing we look at is their entity structure. And I figure that about 50% of the taxes they save, and this is thousands and thousands of dollars, usually tens of thousands of dollars, it'll happen in the very first time we meet, because we'll simply change their entity structure. It is like flipping a switch, and all of a sudden you're paying fewer taxes. So you're talking about thousands, tens of thousands, if you're doing really well, hundreds of thousands, simply by changing your entity structure. We recently changed the entity structure for a new client, and it saved them 25% of their tax bill every year, immediately. 25% of their tax bill. Think about it, if you could flip a switch and save 25% of your tax bill, what would that be worth to you? So what's the difference between an LLC, an S Corp, and a C Corp, and who should use which? Well, an LLC, first of all, is not a tax entity. An LLC is a legal structure, and an LLC can be taxed as an S Corp, or it can be taxed as a C Corp, or it can be taxed as a sole proprietorship or a partnership. So talk to your attorney about whether to use an LLC or a corporation. So there's LLCs, there are corporations, and there are partnerships. These are 3 different legal entities. For tax purposes, there are only corporations and partnerships. However, there are different types of corporations. There are S corporations and C corporations. An S corporation, the owner pays the taxes on the income, and a C corporation, the business pays the taxes. You go, well, why wouldn't I always want to be a C corporation and have the business pay the taxes? Well, the reason is because if you're taking the money out, you can actually pay more tax as a C corporation. So how do I decide when to use which entity? That's where you sit down with a really strong tax advisor, like one of our TFW advisors, or you come to our accelerator class, and they walk walk you through and you understand why. By the way, that's a very important point here. It's very important that you understand why you're doing what you're doing. I've had clients who have asked me 3 or 4 times. I'm fine with that. Make sure you understand what you're doing, because you're the one, I can tell you what to do, but you're the one who's going to have to do it. I don't have your checking account. I'm not doing your day-to-day bookkeeping. You have to do this work. And so you need to understand it. Make sure that your tax advisor can explain it to you in a way that you can understand it. When should you reconsider your entity structure? Well, first of all, do it right now. Okay. So if you haven't actually been through a tax strategy with a strong tax advisor who follows the principles of tax pretty well, then you really ought to sit down and do that right away, because it'll start saving you money immediately. So you want to do it right now. But then every couple of years, you ought to make sure you're talking to your tax advisor. I may have grown. I may have changed what my goals are. I may have changed what my products are. I may have changed how I use AI versus having employees. I may have changed how much money I take out of the business. I may not want to take money out of the business. I may have decided that I want to sell the business, or I may have decided that I no longer want to leave it to my children. Whatever it is, things change. So at least every year or two, make sure you revisit your entity structure. Now, if you're not sure whether your current entity structure is helping you or hurting you, I'm telling you right now, you're not alone. Most business owners pick an entity once and never even think about it ever again, even as they grow out of it and leave money on the table every single year. That's exactly why I created this free training. I'll show you how to set up your business the right way so you legally pay less in taxes with reduced risk and put more money back into growth of your business. Click the link below to register, and when you refer a friend, you'll be entered to win a private one-on-one strategy session with me, as well as a few other surprises. The spots go fast, so make sure you grab yours now before it fills up. Can you really change your entity structure even years after being in business? Of course you can. Now, it's harder. Let's be fair. There's more work to be done. I'll give you an example. Every once in a while, I run into somebody who has investment real estate in a C corporation because they got some really bad tax advice from these people who are promoting online. Okay. And I'm going, well, this is a really bad idea. Well, how do I change that? Well, that's where we sit down and do a real tax strategy. And we have to figure out, how do we make the changes? Are there facts that are in our favor that maybe we won't have to pay so much tax when we make this change? Or do we even need to make the change? But all of those things we have to look at on a regular basis. Now, what are the biggest mistakes people make when they set up an LLC or an S Corp? First of all, they don't choose their entity when they set up an LLC. You have to choose. If you don't choose, you're automatically either a sole proprietorship or a general partnership. Well, those are both bad entities for a business. Instead, you want to choose an S Corp or a C Corp. Okay, now, what's the mistake people make? Well, some people choose to be an S corporation when they really should be a C corporation right from the beginning. Or I see a lot of times some people choose a simple S corporation structure when what they should have is they've got a partner and they should each have their own S corporation, and the business should be operated as an LLC taxed as a partnership. I know that's a lot to get your mind through, so watch this video over and over again. Once again, I see people all the time. They make the simple mistake. Well, there's only 2 of us. We'll just be an S corporation. Here's what happens. You're an S corporation with 2 of you. Let's say you own it 50-50. Great. You're going to split everything 50-50, right? Really? So you want to drive a Lamborghini and your business partner wants to drive a Tesla, and they're okay paying for your Lamborghini? I don't think so. So what are you going to do? Well, that's where a different entity structure makes sense. So it seems like, wow, it should be that simple. And it is simple once you understand what you're doing, but you need to understand what you're doing. And if you have an advisor who doesn't understand what they're doing, or you suspect that you don't know if they know what they're doing because they don't talk to you about it, then sit down with a strong tax advisor, learn from your tax advisor what you should be doing. Now, how do investors, this is one I love, how do investors use multiple entities to reduce their taxes? So first of all, a business entity frequently is in like a corporation, S corporation or C corporation. But if you're investing in real estate, it should almost never be an S corporation or C corporation, especially long-term investment real estate or even short-term rentals. Really like to see that, because a partnership is really good when you need flexibility, okay? Only time a partnership's bad is when you need the specific characteristics of an S corporation or C corporation. For example, you have Social Security taxes, right? Self-employment tax. So if you don't have that on long-term rentals, fundamentals, why would you be stuck in that form? Or let's say that, you want to sell the business down the road, you're not going to be taxed on it. Well, there's some specific provisions, section 1202, that apply to regular businesses. They don't apply to investment real estate. So we want to make sure that we're setting up the right entities so that A, we protect our assets. Because if you look up in the dictionary, look up the word tenant, and really what all it's going to say is plaintiff. If you own investment real estate, if you haven't been sued, it's just that you haven't been sued yet. The day will come when a tenant, even if they've been a good tenant in the past, will decide to sue you. So asset protection is really an important part of this, but it's also important to set up your entities so that you're tax effective. You're setting up the entity in the right state. You're setting up your investment entities so that you've got all this flexibility that you need. Now, what should you ask your tax advisor before you make any changes? I would ask, what questions do you have for me? That's the first question I would ask. What questions do you have for me? Because your tax advisor, their number one goal, their number one skill should be asking good questions. And they should be digging into your entity structure. They should be digging into your family and your relationship with money with your family. They should be looking at your legacy, right? What are you going to do with your money when you die? Well, they should be looking at your investments. What are you going to do with your money to invest it outside of your business? How long are you going to own your business? What do you think you're going to do with your business? These are all important questions, but they're really questions that they should be asking you, not questions you should be asking them. If you're planning to sell your business at any time in the future, this could be the most profitable video you watch all year. There's a section of the tax code, section 1202, that lets you legally pay zero in tax when you sell your business. But here's the catch. Most business owners either don't know it exists or they hear about it too late to use it. In this video, I'm going to show you exactly how it works, how to qualify, and how the right structure today could save you millions when you exit your business. Stick with me because by the end, you'll know how to turn a $10 million exit into a $10 million windfall. To take advantage of this tax exemption, you must meet these key criteria. Section 1202 is part of the Internal Revenue Code that allows for up to 100% exclusion of capital gains when you sell what's called qualified small business stock, or QSBS. In plain English, if your company qualifies and you structure it right, you could sell for millions and not owe a single dollar in federal capital gains tax. Let me say that again. Sell your business, pay no tax. Number one, the company must be a C corporation. S corporations or LLCs taxed as S corporations or partnerships do not qualify directly. So you do not want to convert your S corporation to a C corporation. That will not work. However, if instead you drop all of your assets down into a C corporation owned by the S corporation, that will work. So just because it says that only C corporations qualify and you can't convert an S corporation to a C corporation, that doesn't mean you can't still take advantage of 1202. Number two, stock must be original issue. In other words, you must have acquired the stock directly from the company. You cannot be getting it, buying it from somebody else. So let's take our situation again. Okay, so we have this S corporation. It's operating. Well, if we contribute the business assets to a new C corporation in exchange for the stock of that C corporation, guess what? That is original issue stock. Now, in that case, only the appreciation from the time you make this change, from the time you form the C corporation, only the appreciation from then until you sell it is going to be tax-free. So the sooner you do this, the better off you are. Number three, it must be a qualified small business. What does that mean? It means that the assets, when you form the C corporation, have to be $50 million or less. So if your S corporation is worth more than $50 million, we can only drop $50 million or less of assets into the C corporation. But remember, it's how can we do it, right? It's not can we do it, it's how can we do it. So let's say we have $70 million of assets in our S corporation. Well, let's drop $50 million. Let's keep $20 million out. And so we qualify as a qualified small business. So it's just $50 million or less at the time we receive the stock. And it has to be an active business in a qualified trade. It cannot be a professional services business. Okay, professional services business, like my business, accounting, they don't qualify. Now, how long do you have to hold the business? 5 years. So if you're planning to sell the business in 3 years, you're not going to be able to take advantage of this. However, just because you sell in 3 years doesn't mean that you don't still get the benefit, because if you sell your business in 3 years and you invest the money into a new qualified business, and then you sell that stock more than 2 years later, guess what? You've hit your 5 years. So the reason I bring up these technicalities is because people tell me, well, my accountant said I can't do that. Well, the question is never, can I do it? The question is, how can I do it? How can I do what I want to do, which is sell my business, pay the least amount of tax possible? The challenge is that if you're coming to me right as you're about to sell, I can't do anything for you, right? Say, hey, Tom, I'm about to sell my business, or even worse, hey, I sold my business 3 months ago. Can I do something about the gain? Okay, well, we could do a opportunity zone. Okay, there are actually things we can do, but boy, we can't take advantage of 1202. But I'll tell you, I have found that most businesses can take advantage of 1202. Now, when do you want to take advantage of 1202? If you're going to leave the money in the company, that's when you want to take advantage of 1202, because remember, it has to be a C corporation, which means that a C corporation, of course, has a double taxation, right? They pay a 21% tax on the income when it's earned, but then there's another tax on the dividends. So if this is a company where you pull all the money out, 1202 is probably not the right choice for you. However, if there's even a part of the business where you're going to leave the money in and grow the business, and if your goal is to really grow this business, 1202 is an opportunity you can't afford to pass up. Now, how much can you exclude? Well, interesting, there's a $10 million gain limitation. $10 million on whom? So it's $10 million per shareholder. So could you have multiple shareholders? Well, yes. Now, you and your spouse, you're not multiple shareholders. However, you and a trust, you and your children, you and your other partners, all shareholders. So everybody gets the $10 million. So we can multiply that $10 million. And so don't think that it's just 10 million. So you plan to sell your business for 50 million. Could we get a $50 million exclusion? I guarantee you, if you're willing to do the work that it takes to get 5 different owners in there, we can do that. Now, here's how high income entrepreneurs and investors can minimize the 1202 benefit. First, start a C corporation early, or drop your assets down from your S corporation or your partnership into a C corporation. Do it as soon as possible. Multiple shareholders, each shareholder gets the $10 million exclusion. And you can use trusts and family members. We call this stacking and packing. You can use trusts and family members to multiply the exclusion. And your exit timing is important because it's 5 years from the time that you first get your stock. Now, I've had clients where they sold their company or some of their company. Let's say they had a new investor come in and they sold some of their stock to that new investor, say after 3 years. Okay, well, that stock didn't qualify because it's only 3 years. But then 3 years later, they sold some more stock to new investors. Well, guess what? 3 years later, now we're at 6 years. Now we qualify. So just because that first investor doesn't qualify doesn't mean the next investor might not qualify. Now, a couple of things to watch out for. Remember, professional service industries, law, accounting, finance don't qualify. Second of all, healthcare, by the way, also. It has to be stock. You can't sell debt, and it can't be an S corporation stock, can't be a partnership, it has to be C corporation stock, cannot be the assets of the company. Now, there are a lot of buyers that don't want to buy the stock. There are ways to deal with this. There's ways to deal with that depending on what the buyer insists on. Okay. So be sure to bring in a good tax planner, a really good tax planner, both an accountant and an attorney to work through this with any buyer because it does have to be stock. And remember, state taxes could be different. So you could still end up paying state tax. Of course, there are other ways to avoid state tax on the sale of your business. Now, remember, number one, your business must be a C corporation. If you're a partnership, LLC tax is a partnership or an S corporation, then you'll need to restructure. But don't worry, we got that covered. Number two, You must buy the stock directly from the company. It has to be original issue stock. You can't buy it from somebody else. Now, if it's a gift from somebody else and it was original issue stock to them, it will still qualify. Okay. Number 3, your company's assets have to be under $50 million. Okay. At the time the stock is issued. After that, it can go up to $300 million. Doesn't matter. It's at the time the stock is issued. Basically, that's the government's way of saying we're incentivizing small businesses. We're not incentivizing big businesses. And number 4, remember, you have to hold the stock for 5 years. Here's a bonus. Your business has to be in a qualified industry. That includes most product-based companies like online retailers, tech startups, manufacturers. Certain service-based businesses like law, finance, accounting, and healthcare don't, but there are some that might. Okay, so you might think I'm in the healthcare business and you may actually be in the retail business, like a pharmacist. So a pharmacist may qualify even though you think of a pharmacist being in the healthcare business, when in fact, the way their business is set up, it may not be healthcare under the law. So make sure you follow every little word of the law. Every word counts when it comes to the law. Most business owners lose millions in taxes when they sell, simply because they don't know about Section 1202. The tax-free exit blueprint shows you exactly how the wealthiest founders pay zero, legally pay zero in federal capital gains tax when they exit. Inside, you'll discover the 4 must-have criteria to qualify for a 100% tax exclusion. How to structure your business now to cash out tax-free later, the strategy smart founders use to multiply the exclusion for partners, spouses, and family trusts, and how to turn a $10 million sale into a $10 million windfall completely tax-free. If you plan to sell in the next 3 to 7 years, this is required reading. If it's even longer than that, you still want to start now, because the sooner you start, the bigger your exclusion is. The best time to plan your exit was 5 years ago. The second best time, right now. You can download the PDF below. Now, here's the fun part. How much can you actually exclude? Under Section 1202, you can exclude the greater of $10 million or 10 times your original investment basis. I rarely see the 10 times come into play because normally people have invested less than $1 million, right? $10 million is usually bigger. So if you started your company with $500,000, sell it for $6 million, that's actually $5.5 million in tax-free gain. Now, it might have been you put $500,000 in and you put it into an S corporation, you got your deduction for that $500,000 because it was all in costs. So now your basis is zero. You now form the C corporation. So see, when we talk about different entities, we always want to talk about how to use all of the entities together. Don't think that just because it's 1202, we've got to do a C corporation. Yes, we do. But that doesn't mean that we don't also use an S corporation or an LLC tax as a partnership. Those are options that we always need to take into account when we're looking at your specific situation. What if you invested $1 million and sell it for $12 million? You can exclude up to $10 million of that. And if you invested $2 million and sell for $20 million, you could actually exclude up to $20 million, 10 times your basis. So it really is that every once in a while, I see that 10 times apply. So don't forget it. It's the greater of $10 million or 10 times your basis. Now, of course, if I was investing less than $2 million and I sold for $20 million, I'd really just multiply my exclusions, right? So that we can actually take advantage of the whole $20 million. Each shareholder, remember, gets their own limit. So if you planned ahead with family trusts or partners, you can multiply the exclusion. Section 1202 is one of the biggest tax savings opportunities any entrepreneur has. Your single biggest asset is probably your business. It's not your home. For employees, it's their home. For you, it's your business. And you probably don't have a lot of basis. That's your tax cost. That's how much you paid for your business minus whatever losses you took in the early years. You probably don't have enough basis. And so you're probably going to have huge capital gains. Most entrepreneurs have capital gains almost equal to their selling price. They have very little basis in this. So if you can imagine $10 million and multiple of $10 million being tax-free, that is the name of the game. Even at a 20% capital gains rate, that's $2 million of tax savings for every $10 million of gain that you're not recognizing. But remember, it takes planning. You don't just wake up one day and sell tax-free. You have to set your business up correctly, ideally 5 years before the sale. And if you're not a C Corp yet, now is the time to evaluate whether you need to set up a C corporation. Remember, we're not converting an S corporation to a C corporation. We're actually forming a new subsidiary of the S corporation, putting the business assets in so that we can take advantage of Section 1202. So if you're building a business that you plan to sell, you already own stock in a startup, don't leave millions in taxes on the table. With the right structure, the right timeline, and the right guidance, you could exit your business and legally pay zero in capital gains taxes. This is not something to figure out after the sale or right before the sale. The best time to set this up was 5 years ago. The second best time is today. At Wealthability, we specialize in helping business owners like you design tax strategies that make exits like this possible. We don't just prepare taxes. We help you build permanent generational wealth. Schedule a strategy call today at wealthability.com and let's map out your path to a tax-free exit.